In the last few videos in my Glide Path to Retirement series, I showed you the 4% rule and where it falls short. I walked you through the hybrid 6% rule and its guardrails. And I showed you the kicker, how you buy the market when it is down. I promised you the numbers and the back testing to back it up. Today, you get them. Here's the great news for those that do not trade options. You do not need them for this video. Today, we are building the version anyone can run, a plain portfolio of stocks and bonds. We are going to take it from 80-20 allocation down to a 60-40 allocation, run every one of them through the hybrid 6% rule and show you the pros and cons of each. We will touch on the taxes, withdrawal strategies, and introduce the final rule of the hybrid 6% strategy. By the end, you will know exactly which mix fits your retirement you want. And I will tell you up front, the question is not which one survives, they all survive. Every one of them across every retirement since 1958. The real question is which one fits you, because each mix pays you differently and rides differently. And the right answer depends on how big your nest egg is and how steady a hand you have. This portfolio has two jobs. Job one, hold the 6% paycheck. Job two, grow that paycheck with inflation so it keeps its buying power for 30 years. Job one comes first because we are already starting higher than almost anyone recommends. If we cannot defend the 6%, nothing else matters. Now, if this is the first video of mine you have landed on, you can still follow everything here. The hybrid 6% rule is a retirement withdrawal system. You take 6% of the highest value your portfolio has ever reached when the market is strong, and the rule automatically steps you down to 5 and then 4% when it drops. Then back up when it recovers. You spend more in the good years and protect yourself in the bad ones. This video stands on its own, but if you want the full detail behind what we are using today, then these two videos right here go deeper. One breaks down the hybrid 6% rule in full. The other covers the kicker when you buy the market on sale in a crash. Watch them after this one. Let me walk you through what a 6% withdrawal really costs, because it costs more than 6%. Start with $1 million. You want to take your 6%, that is $60,000, you pull it out, and you are left with $940,000 still invested. For your portfolio to be just as strong next year as it was this year, that $940,000 has to do two things. It has to climb back to the full million it was before you took your paycheck, and has to gain a little bit extra on top, because the next year everything costs more. If inflation runs around 3%, your target is not $1 million anymore. It is now $1,030,000. So your $940,000 has to grow to $1,030,000 in 1 year. If you run that math, and that return you need right around 9%. That is the bar. So to hold a 6% paycheck and to keep it growing with inflation, the portfolio has to earn somewhere in the neighborhood of 9% a year over time, on average across the whole retirement. Here's how that affects you. As long as your portfolio stays at or near its high water mark, you take the full 6%. But if it falls more than 10% below that high water mark, the rule steps you down to 5%. More than 20% below, it cuts you to 4% and holds you there until the portfolio recovers. Good markets, you take the full paycheck. Bad markets, the guardrails ease you back automatically, so you are spending less exactly when the portfolio can least afford it. Before we get to the portfolios, two quick mechanics, because how you take the money matters almost as much as what you're invested in. First, where you pull each month's paycheck from. You take it from whichever side is up. If stocks are running, you sell a little stock. If stocks are down and your bonds are holding, you pull from the bonds and leave the stocks alone to recover. You are always selling strength and protecting the part that is hurting. Second, and this is a little different from what a lot of other retirement channels will tell you, a lot of them love buckets. Keep 1 year spending in cash, maybe 3 years in something safe, so you're protected if the market drops. The instinct makes sense. Nobody wants to sell stocks in a crash to pay the bills. But think about what that bucket actually is. Every dollar you move into it is a dollar you just pulled out of an engine that historically earns between 9 or 10% and parked on the sideline earning 3 or 4%. Go back to the math from a minute ago. Take $5,000 out this month instead of the whole year at once, and you still have $995,000 working. Spread it across the year and you keep on average about $970,000 in the market the whole time. If you pull the full $60,000 in January instead, and you drop to $940,000 for the entire year, that is on average $30,000 of your money that stops working, and the bigger the bucket, the bigger the number gets. So the bucket does not give you safety for free. In the back testing, pulling your income in big chunks up front drags your return by around 0.5% a year. If buckets help you sleep, run them. That peace of mind is worth something. Just know you are paying about 0.5% a year for it. The fix is simpler and it costs you less. Take your income monthly the way you got a paycheck when you were working. Most of your money stays invested most of the year doing the job you need it to do. That lets your money stay working for you until the last minute you withdraw it. One quick note on taxes because it affects how you run this. Bonds and stocks aren't taxed the same way. The interest your bonds pay gets taxed as ordinary income, the same rate as a paycheck from a job. Stocks you have held longer than a year get the lower long-term capital gains rate. So a portfolio with a real bond sleeve gives up a little bit more to taxes than a regular brokerage account. That is why a tax-deferred account, a 401k or an IRA is the preferred home for this. None of that yearly tax drag applies here. You can absolutely run it in a brokerage if that's what you have. You will just pay some tax along the way, which is true of almost anything you hold there. Everything you're about to see is run in a tax-deferred account. Now, the real question. You cannot go all stocks. An all-stock portfolio gets cut in half in a bad crash. And worse, you have no safe money to live on while it recovers. So, you are forced to sell at the bottom. You need some bonds. The question is how many? So, I took 3 plain stock and bond mixes. And let me be specific about what's in them. When I say stocks, I mean the S&P 500. Just the broad market, nothing fancy. And the bonds are run with the same bond rotation rule I use on this channel, the one a lot of you already know. The rule rotates the bond sleeve to short treasuries when the signal says so, and back to medium duration treasuries when it's safe. So the safe money actually stays safe through a rising rate stretch instead of bleeding out. I ran every one of these mixes through the hybrid 6% rule across all 38 of the 30-year retirement windows going back to 1958. Each one starting with the same rules and the same $1 million. The headline, they all 3 survived, every window with 0 failures. None of these portfolios ran out of money when withdrawing out of the hybrid 6% withdrawal strategy going all the way back to 1958, including a retiree who walked straight into the worst stretch in modern history. So this is not a story about which one works because they all work. Here's what they paid, and remember that these are all median numbers across all 38 windows in this section. The 80-20, 80% stocks paid the most, a median of about $3.2 million in lifetime income. And it left the biggest pile at the end, a median of around $3.5 million. The price was the roughest ride, a worse drawdown around 39%. The 70-30 paid a little less, around $3.1 million in income, with a smoother ride near a 34% drawdown. And the 60-40, the textbook retirement portfolio, paid the least, about $3 million, but gave you the calmest ride by a wide margin with a drawdown around 28%. Now, remember this? I told you the rule throttles you down to 5 and 4% in the bad years. So you would think the safest portfolio, the 60-40, would spend most of its time at the full 6%. Well, it does. It sits at the full 6% about 19 of the 30 years on average. The stock-heavy 80-20 only holds the full 6% about 17 years. It gets knocked down to the 4% setting more often because it takes the deeper drops. So the 60-40 pays you the full rate more often. Sounds like the winner. But look again at the dollars. The 60-40 held 6% more often and still paid the least at about $3 million, while the 80-20 held it less often and paid the most, about $3.2 million. How? Because it is 6% of what? Both portfolios start at the same $1 million, but the 80-20 has more stock working for it. So over the years, it grows faster. And 6% of that faster growing pile is a bigger check than 6% of a slower growing pile. The 60-40 sits at the full rate more often, but it is taking that rate off a smaller base because it grew slower. So do not let that rate fool you. How often you sit at the full 6% is a comfort signal. It tells you how smooth the ride was. It is not an income signal. The income is in the dollars, and the dollars favor the portfolio that grows faster. Which brings up the question that actually matters for you, and is the one the median hides. How big is the portfolio you're retiring on? Because the size of your nest egg changes which mistake you can afford to make. If you are retiring on $2 or $3 million, you have got room. Lean toward bonds, take the smoother ride, and even in a bad stretch, the dollars are still there. You are optimizing for peace of mind, and you have earned it. But if you were retiring on something tighter, say $500,000, the math is less forgiving. Your withdrawal has to do real work, and you do not have a cushion to fall back on if the portfolio grows slowly for a decade. That is the situation where you may need to lean more towards stocks. Not because it is comfortable, but because you need the growth to manufacture the income. And you accept that the rule will throttle you to 4% in the rough years as the price of the bigger paycheck and the good ones. So it could be about temperament, but it is also about margin. The more you have, the more you can buy yourself a calm ride. The less you have, the harder your money has to work, and the more you will have to be willing to ride out the rough years to get there. There is one move that helps no matter which allocation you pick, and that still uses no options at all. It is the kicker. This is the other video I mentioned to watch at the beginning, but the quick version is when the market falls 40% from its peak. That is historically one of the best buying opportunities a retiree will ever see. And most people are too scared to touch it, so the kicker rule does it for you. When the market drops 40%, not when your portfolio drops 40%. Your portfolio holds bonds, so it hopefully never falls as far as the index does. We are watching the S&P 500, and when it is 40% off its high, that is the signal. You sell your bonds and you go all in on the S&P 500, the ride to recovery. Then, when the market climbs back to within 20% of its old high, you rotate back to your normal mix. Across the same 38 window, adding that one move lifted every allocation. And it did something specific I want you to notice. It brought back the full 6% years. Remember the 80-20 only held the full 6% about 17 years on its own? Well, with the kicker, that jumps to about 21 years. And the time stuck at the throttled 4% setting gets cut roughly in half. The 70-30 and 60-40 improved the same way. The kicker does not just add income, it adds good years. The years you are taking the full paycheck instead of the reduced one. And the income followed. The 80-20 went from a median of about $3.2 million up toward $3.4 million. That's more income with more full rate 6% years and much quicker portfolio recoveries. That last part is the key. The recovery to your portfolio was much faster. That is because this move only fires at the very bottom of a deep crash, where going aggressive costs you almost nothing in extra risk, but captures a lot of the recovery. You can run it, or you can skip it. Skip it and you still survive every window, you just leave some of the recovery on the table. It is a bonus, but not a requirement. There is one last piece and it completes the system. Call it the 9% ceiling. It is the final rule and it is the only one I have not put in front of you yet, mostly because it does not need a whole video of its own. It is simple and obvious. Think about the guardrails we already have. The hybrid 6% rule steps you down in bad markets, and underneath it sits a floor that protects your income against inflation. That floor is a good thing almost all the time, but it has no ceiling. Picture a long, grinding bear market where your portfolio is down for years and inflation is climbing. That floor can start demanding 10, 11, even 12% of a portfolio that has already been beaten down. And pulling that much out of a shrinking account is how you strip mine your own retirement. So the rule is actually pretty simple. At the rebalance each year, you never withdraw more than 9% of what the portfolio is actually worth, no matter what the floor wants. It all ties straight back to the math from the beginning. Remember, the portfolio has to earn around 9% a year just to stand still, just to replace what you pull and keep up with inflation. So if you start pulling 10, 11, or 12% off an account that is already beaten down, you are taking out more than it could ever earn back. You are not just spending your income anymore. You are eating the capital that is supposed to grow you out of the hole. The growth engine never gets a chance to work. Now, here is what the data shows for these stock and bond portfolios. The 9% ceiling almost never does anything. In a normal retirement, it never gets touched. For the typical retiree, it is invisible. It only bit in one era, the worst era for a retiree in modern American history. If you never lived through it or saw it, it is worth understanding just how bad that era was. From 1966 to 1982, the stock market went nowhere for 16 years. The Dow was around 1,000 in early 1966, and it was still around 1,000 in late 1982. 16 years with no gain. But over those same 16 years, inflation cut the value of a dollar by more than half. So a retiree drawing income watched their withdrawals climb every year to keep up with prices, while their portfolio went flat to down in real terms for almost 2 decades. Inflation hit 13, 14% at the end of it. The Federal Reserve had to push interest rates close to 20% to finally break it. My own father carried a mortgage north of 18% in those years. That was the world back then. That is the kill zone for a retiree. Not a single violent crash you recover from in a couple years, a slow bleed that lasts a decade and a half. A 2008 style crash is scary, but the recovery comes fast. The stagflation grind just kept taking year after year. And this is where that 9% ceiling comes back in. We already covered why it exists, so I won't rehash it here, but honestly, in these stocks and bond portfolios, the ceiling barely fired at all. The kicker had already done most of the heavy lifting by buying the recovery for you. So the portfolio almost never got pushed up against that line. Over a full 30 years, capping it made about a 4% difference. And a lot of the windows, it did nothing at all. It just sits there. But that is the point of it. We already established that if you keep pulling more and more out of an account that is shrinking, there is a point of no return. And you do not come back from it. So the ceiling is there for the ultimate test, for the stretch we haven't even seen yet. The one worse than anything in the back test. You never know what the future holds. The brake is installed quietly, and if the day ever comes that you need it, you will be glad it was already there. One thing worth clearing up, because you might expect it. You would think the stock heavy 80-20 and the conservative 60-40 would end up miles apart after a stretch like this. They do not. Run the full system through the kill zone and all three allocations land within a whisker of each other. A median right around $2.6 to $2.7 million. The reason is the kicker. When the market hit bottom, the kicker pulled every one of these portfolios into stocks for the recovery, so they all came out of the other side holding much the same thing. In the worst era, your stock to bond mix is almost beside the point. The kicker is what carried you, not the allocation. Now let me do something with this data that I think matters more than any single number I have given you so far. Every median number I just quoted, that $2.6 to $2.7 million, includes the 1966 to 1982 stretch. The single worst era in modern financial history is sitting right inside the average, dragging every number down. Honestly, do you expect a 16-year, zero return, double-digit inflation grind in your retirement? Maybe. Nobody knows. That is exactly why we stress test against it. But it is one era out of many, and it may never come again. So let me pull it out and show you the rest. Take every retirement window that did not start staring down stagflation. Run the same full system and look at what happens. The median final jumps from that 2.6 to 2.7 million range up to somewhere around $4.2 to $4.6 million, depending on the allocation, with lifetime income climbing right alongside it. The same kicker, the same ceiling, the same 6% paycheck. The only thing that changes is which era you happen to retire into. So roughly $2.7 million if you retire into the worst stretch we have ever recorded. Roughly $4.5 million if you do not. That is not a story about stocks versus bonds, and it is not a story about the rules. It is a story about timing and sequence of returns risks that you do not control. The lower number is your insurance figure, the worst case if the 1970s come back. The higher number is the base case if they do not. You should know both. Plan with the cautious one, but do not let it convince you the strategy is weaker than it is. It is carrying the weight of the single worst stretch we have ever recorded, and it has still never failed. So step back and look at what we found. A 6% paycheck demands a portfolio that earns its way past your withdrawal plus inflation, somewhere around 9% a year over time. Plain stocks and bonds can clear that bar and survive a full retirement. Every window we tested at 80-20, at 70-30, at 60-40 with no options required. And the choice between them is more personal than the medians let on. Stock heavy pays more dollars even though it sits at the full rate less often. And it matters most when your portfolio is smaller and you need the income. Bond heavy buys you a smoother ride and is a luxury you can afford when your portfolio is larger. Outside the one nightmare era, all three delivered more than the headline suggests. Inside it, the ceiling and the kicker are what carry you through. But every one of these still forces the same compromise. The only lever you have in a plain stock and bond portfolio is how much bond to hold. And every bond dollar you add buys you a smoother ride at the cost of your paycheck. You can lead toward income or you can lead toward calm. In this world, you cannot fully have both. That is the wall. And in the next video, I'm going to show you a structure that climbs over it, a way to hold mostly bonds for the smooth ride and still pull the income of a stock-heavy portfolio. That is where the options come in. Here is where this is going. The next video is the last piece of the Hybrid 6% series and is the options version, the barbell. And then I'm going to close the whole loop. I'm going to put all of it side by side, the options barbell, the no options stock and bond version you just watched, and the plain old 4% rule from my very first videos. Same two retirees I have used all along, the one who retired in the year 2000 right into the dot-com crash, and the one who retired in 1982 right at the start of the great bull market. the unlucky one, and the lucky one. We will see exactly how the 4% rule, the hybrid 6% rule with no options, and the hybrid 6% rule with options barbell each treated those two people. That is the finale. So drop a comment and tell me, where would you set the dial? Would you run the 80-20 for the bigger paycheck? Or would you prefer to sleep better at night with a 60-40 and take the smaller check? If this made the trade-off clear, hit the like button so it reaches more people staring down the same decision. And if you want rules-based retirement investing without the hype, the kind where I show you the mechanics and then prove them with decades of data, subscribe. Stay disciplined, stay patient, and I'll see you on the next flight.